Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Acotec Scientific Holdings Limited annual report. Acotec Scientific Holdings Limited offers a wide range of medical device products for various therapeutic areas. In the field of vascular intervention, the company provides devices such as paclitaxel-coated DCBS, PTA balloons, and peripheral aspiration systems to treat lower extremity artery disease and chronic limb-threatening ischemia. In addition to vascular surgery devices like ACO-ART Iris and Jasmine, ACO-ART Lily and Rosmarin, and introducer sheath sets, the company also offers cardiology devices including semi-compliant PTCA balloons, coronary CTO recanalization balloons, and cardiac valve balloon dilation catheters. These products are designed for use in various procedures such as angioplasty and stenting. The company's product portfolio also includes nephrology devices like paclitaxel-coated high-pressure balloons and AV scoring balloons, which are used to treat kidney-related conditions. Furthermore, Acotec Scientific Holdings Limited provides neurology devices, including intracranial PTA balloons, for the treatment of neurological disorders. Overall, the company offers a comprehensive range of medical device products that cater to various therapeutic areas, making it a significant player in the interventional medical device market. Acotec Scientific Holdings Limited maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Acotec Scientific Holdings Limited trades at a higher price-to-earnings ratio of 29 times and a higher price-to-book ratio of 2.48 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 19% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the introduction and commercialization of new products have been instrumental in driving revenue growth, with a notable increase of 51.1% year-on-year in venous intervention, vascular access, and other products. Additionally, the registration approval for new products such as Lavender and Viotter has also contributed to this growth. Furthermore, the expansion into new therapeutic areas, including peripheral vascular aneurysms and interventional oncology, has provided a significant boost to revenue. The company's nationwide hospital coverage network and increased industry influence through academic leadership and channel empowerment have also played a crucial role in driving revenue growth. On the other hand, the primary drivers of revenue decline can be attributed to a decrease in core products by approximately 0.4% year-on-year and a significant decline of 24.1% in overseas customers' revenue. These factors highlight the importance of diversifying revenue streams and maintaining a strong presence in both domestic and international markets to mitigate potential declines in revenue. The financial performance of a company underwent some changes between 2024 and 2025. One notable change was in the gross profit margin, which decreased by 1.5 percentage points from 75.4% in 2024 to 73.9% in 2025. This decline indicates that the company's ability to maintain its pricing power or control costs may have been compromised during this period. Despite this decrease, further analysis of net income is required to fully understand the company's financial health and overall performance. The company's financial performance indicates a positive trend in its operating cash flow. According to the data provided, the operating cash flow for 2025 was a significant RM $123,219,000. Furthermore, an increase of approximately 9.7% in cash generated from operating activities was observed, reaching RMB 948 million by December 31, 2025. This upward momentum suggests that the company is successfully managing its finances and generating sufficient cash to support its operations. The company's financial situation has undergone significant changes. A notable increase in non-current liabilities, specifically bank loans, from RMB 10,000 in 2024 to RMB 68,256 in 2025, indicates a substantial rise in debt level. This is further supported by the total borrowings, which increased from RMB 10 million to RMB 68.3 million. The increase in debt has led to a significant surge in interest expenses on bank loans, rising by 299% from RMB 271 to RMB 1,085. However, it's worth noting that finance costs decreased by 10.4%, but this is attributed to a decrease in interest expense on lease liabilities rather than an overall reduction in interest expenses. Overall, the company's debt level and interest expenses have increased significantly due to the rise in bank loans. Management is optimistic about the company's future prospects. In the short term, they are focused on receiving approval for various products from the NMPA, expanding manufacturing capacity through new premises in Beijing and Shenzhen, and solidifying their position in the DCB market. In the long term, management aims to become a global leader in interventional solutions for vascular diseases by expanding product offerings through technological innovation and research and development. They plan to increase investments in R&D capabilities and grow through self-development, mergers and acquisitions, and other means. The company also plans to expand into new sectors such as vascular surgery, cardiology, neurology, and oncology, and receive more marketing approvals to generate sales from overseas markets. A key strategy for global expansion is a deepened strategic partnership with Boston Scientific. To support business growth, management will focus on talent development and team building by investing in the talent pool and supplementing the team with experts in biomedical engineering, mechanical engineering, and materials science. Concerns about inventory buildup and supply chain disruption. The recent data suggests that there may be issues with inventory buildup in the supply chain. A significant increase in raw materials inventory has been observed between 2024 and 2025, with a notable rise of 18%. This increase from 76,225,000 to 89,726,000 indicates a substantial accumulation of stockpiles. This trend raises concerns about potential supply chain disruptions if not managed properly. Excessive inventory can lead to wasted resources, increased storage costs, and reduced efficiency in the production process. It is essential for companies to reassess their inventory management strategies to prevent such issues from arising in the future. That concludes the financial summary for Acotec Scientific Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.